You know the holidays are just around the corner when you start hearing about festive cheer, family get-togethers, and, well, a pretty weird stock market pattern. Today, we're going to unwrap a piece of Wall Street jargon that sounds way more festive than it does financial: the Santa Claus Rally. It's a fun question to ask, right? I mean, does Santa really make a pit stop on Wall Street? Well, in the world of finance, the answer, believe it or not, often looks a whole lot like yes. So let's dig into what that actually means and why some really serious traders have been tracking his arrival for decades. All right, so to really get our heads around this, we need a super clear definition. What exactly is the Santa Claus Rally? And just as important, when does it supposedly happen? Okay, now the wording here is absolutely crucial. Notice it says a historically observed tendency. This is not a guarantee. It's not some law of financial physics. It's more like a recurring pattern, kind of like a seasonal quirk, where the stock market, usually measured by the S&P 500, tends to get a little lift. And here is the key detail, you guys. The timing is incredibly specific. We are not talking about the entire month of December. The rally period is just the last 5 trading days of the year, and then it rolls over into the first 2 trading days of January. That's it, a really short 7-day window. And just so you know, this isn't some new slang that popped up on the internet. The term was actually coined and made popular way back in the 1970s by a guy named Yale Hirsch. He's the founder of the Stock Trader's Almanac, which is a super respected guide that's been tracking market cycles for ages. So if this rally has some real history behind it, the next logical question has to be why, right? Why does the market seem to get this little holiday gift right at the end of the year? Well, there are a few leading theories out there. Now, there's no single confirmed reason, but it's probably a mix of a few things. First, you've got just plain old holiday optimism. People are generally in a better mood, feeling good about the future. Then, there's lower trading volume. A lot of the big shot institutional traders are on vacation, which means there's often less pressure from major sellers. You also have portfolio tweaks. Most of the selling people do for tax reasons is already finished. And finally, you get this fresh wave of cash from retirement accounts hitting the market right at the start of the new year. Okay, so we know what it is, and we have some ideas about why it might happen. But why on earth do you hear about it on the financial news every single year? Why do serious traders actually pay attention to this fun-sounding trend? Well, the answer really comes down to simple probability. If you look back at the historical data, this rally has happened somewhere between 70 and 80% of the time. Now, in the world of markets, which is full of uncertainty, any pattern that shows up that reliably is definitely going to get noticed. It's one of the most consistent seasonal trends out there. This whole thing has been around so long, it's even got its own little piece of Wall Street folklore. This old saying basically means that if that traditional year-end rally doesn't show up, some traders take it as a bad sign, a warning that the market might be in for a rough year. And by the way, Broad and Wall, that's just a reference to Broad Street and Wall Street, the historic home of the New York Stock Exchange. Okay, this brings us to what is probably the most important part of this whole explainer. We really need to separate the jargon from any kind of guarantees. So is this a reliable tool you can use to make money, or is it just some interesting financial story? So here's the absolute bottom line. The Santa Claus Rally is a tendency. It is not a rule. A huge announcement from the Fed or some major geopolitical shock can easily come along and completely wipe it out. That's why it's best to just think of it as interesting market context, maybe a nice little tailwind, but never, ever as a trading strategy all by itself. And this slide right here perfectly shows where the Santa Claus Rally fits into the financial universe. Is it official Wall Street jargon? Oh yeah, absolutely. You'll hear it on all the major financial news networks and read about it in market reports. But is it a formal academic theory that you'd find in a finance textbook? Nope. It's not part of the official models used to price assets. It's more like a piece of practical market lore that just happens to have some historical data backing it up. So, to wrap this all up nice and neat, the Santa Claus Rally is a real, widely discussed seasonal trend that has decades of data behind it. But, and this is the most important part, what happened in the past is never a guarantee of what will happen in the future. So that really leaves us with the final question, doesn't it? Is this rally a small, but maybe genuine, predictor of how the market feels heading into the new year? Or is it just a quirky holiday habit from the past that's probably going to fade away as markets get more and more efficient? The data says it's a real pattern, but whether you should actually listen to it, well, that remains part of the great Wall Street debate.